Today, spot XRP ETFs brought in $63.85 million. When you add that to the almost $54 million from yesterday, it's no longer noise, it's a trend. XRP is not being traded by institutions. Instead, they are holding on to it, methodically and quietly. And if things keep going at this rate, OTC desks will soon have a big problem. Where does the next batch of XRP come from? Supply is getting limited, ETFs are sapping liquidity, rules are getting stricter, and central banks around the world are getting ready for digital currencies. This is all going on while the price doesn't change much, which is how the biggest changes always start. This is the truth that most people miss. Price is not the first thing that changes, it is the last. Flow is the most important thing, then infrastructure, then rules, and finally price. And right now, XRP is doing things that most assets never even come close to doing. Spot XRP ETFs have now received close to $1.2 billion in new money. That's not guesswork. That's capital with rules, regulations, and a long-term goal. Even more important, money has been coming in for 23 days in a row. There were no panic sales or big losses. There's no sign that banks are flipping this to make quick money. This is setting up. That might not seem like a big deal at first, but things get interesting here. To put pressure on XRP, 10%, 20%, or 30% of the stock doesn't have to be locked up. The behaviors are very different at 1%, 2%, and 3%. Liquidity gets less. Volatility goes up. Along with that, OTC desks start to feel the stress. These desks have been quietly feeding institutions without changing prices. OTC desks don't always have stock. They began by taking stock. Every new ETF that comes in uses up that stock. There will only be one place to get XRP after it runs out, the free market. Then the noise starts. Now think about this new way of looking at the upside. It has already been shown that $11.5 billion can come in on a single trade day with coin ETFs. That really did happen. Also, this isn't about XRP turning into Bitcoin. It's about how capital acts. Tribal stories don't matter to institutions. They care about usefulness, liquidity, and rules. These things are being done faster with XRP than with almost any other digital currency. What hasn't happened yet makes this even more interesting. We haven't seen a single day with a lot of folks leaving. That's important. It tells us that institutions are still adding jobs, not taking them away. Another ETF launch is coming up. 10 to 15 goods related to XRP might come out in the next 3 to 6 months. Each one adds another pipe that takes supply away from the system. In this case, price stability is not a sign of weakness. This is a good thing. This is taking in. Let's take a step back and talk about rules, because this fits in with the other pieces of the puzzle, even if it takes longer than planned. People in the US thought the Clarity Act would move more quickly. Instead, it has been pushed back again. Hearsay was moved up to the new year. Possible votes falling even more, and it's possible that we won't see everything clearly until 2026. That makes small buyers angry, but institutions really know how to work with this speed. Financial rules always move slowly until all of a sudden they stop. The stopping points show what's going on. Lawmakers are arguing about whether government workers should be able to make money from crypto businesses while they are on the job. They have different ideas about how much DeFi should be controlled so that new ideas don't die. And finally, and this may be the most important thing, there is a rising fight between banks and crypto. As they should be, banks are scared. In a world where crypto platforms can offer 5 to 6% yields and banks only offer 0.25 to 0.5% on savings, money doesn't stay put. Money moves around. That's why there is a lot of push to lobby right now. This isn't about keeping customers safe. It has to do with keeping leftover margins safe. But here's what you should remember. Crypto no longer has to fight to be accepted. It's a battle for market share. Now we're in a whole different stage of adoption. Let us now talk about Europe, as what's going on there is also very important. Officially, the European Central Bank is done with its work to get ready for the digital euro. The framework is taking shape, but the public launch isn't due until later. The legislation should be finished in 2026. Pilot projects could start as early as 2027. And the ECB has said that it wants to be ready to issue by 2029. That may seem like a long way off, but in the world of central banks, that's really quick. Even more interesting is the fact that some countries like Japan might move even faster. That brings up a valid point. Not every CBDC will go live at the same time. Some areas may get ahead of others. And the infrastructure that makes interoperability, payment, and liquidity possible will be very important. This is where networks made for payments and open ledger technology become very important. Now, it's clear that CBDCs make some people feel bad. Concerns about surveillance are real. Privacy is important. Protecting consumers is important. But from a military point of view, nations need to be ready. If you need digital currency infrastructure but don't have it ready, that's the worst thing that can happen. This is clear to Europe. This is clear to the US. The question is not if, but how. People in the private sector keep building while politicians argue. That brings us to Ripple. There's been a lot of talk lately about whether or not Ripple is a bank in the US. Let us get this straight. A first step toward creating a national trust bank has been approved by Ripple. That doesn't mean the bank is open today. This means Ripple can now build it. It takes time to do that. The infrastructure, follow-up, safety online, staffing, savings, things. This is likely to take 9 to 12 months to build out, at least. Not only that, but Ripple already works closely with the NYDFS, the same government agency that approved RLUSD, so they're not starting from scratch. The price of XRP also didn't go through the roof because of this. Banks are the ones who need to know this news, not traders. It helps big businesses figure out which people they can trust to move a lot of money. In finance, trust comes from rules, and Ripple just got a huge boost in confidence. Brad Garlinghouse has already given hints that growth will speed up in 2026. That timeline works ideally with clear regulations, more ETFs, and a mature infrastructure. Big changes in money never make a lot of noise. Things happen slowly at first, then all at once. It's not just regulation and banks that are in this quiet build phase. It takes place at the procedure level too. The ex-dev team at Ripple is working hard to make the XRP system more programmable. Not by copying Ethereum, but by being good at what XRPL already does. Efficiency that has a reason. Smart extensions and WASM-based modules let devs change how things work without making the base layer too big. Smart escrows, conditional payments, and on-chain and off-chain logic that works together are already becoming more adaptable. This is important because hype doesn't lead to mass acceptance. It comes from how things work. Businesses need to be able to plan ahead. Their work needs to be done. They need tools that get real tasks done without making things too hard. As all of this is happening, the bigger picture is slowly changing in crypto's favor. Cryptocurrencies haven't had their time yet, but it's not because the cycle is broken. It's because the business cycle has been slow. Capital has moved out of the risk curve in the past when earnings go up and liquidity grows. First the big caps, then the small caps, and finally the other options. The same trend shows up in crypto. Also, there's a strong case for saying that 2026 will see a rise in cash. Policy changes, credit growth, and fiscal support. As time goes on, more money in the system will make its way into risky assets, whether you like it or not. That's not a lie. Which is how circles work. In the big picture, it's clear that XRP isn't responding yet because it doesn't need to. This is because of things like ETF inflows, supply absorption, regulatory progress, banking integration, CBDC preparation, protocol development, and macro tailwinds. Things are getting ready to start. The ETF data by itself tells a story that the price hasn't told you yet. Banks don't buy 23 days in a row by chance. They don't keep adding exposure unless it helps their argument. They also do it with a long-term view in mind. These aren't deals. These are the distributions. It is very important to do this because the supply patterns of XRP are very different from those of most other assets. A big chunk of XRP is already escrowed, locked, or held carefully. When you add ETFs to the mix, the liquid float is much smaller than what the top supply numbers show. That's why small rises in demand can have big effects in the long run. This is another important reason for the OTC desk debate. OTC desks exist to keep market effects to a minimum. They let big buyers pile up without driving up prices. But they're not pots of cash that never run out. They do work until they don't. When they can't keep up with demand, the market has to change prices to get people to buy. That change isn't always easy. Add to that what's going on with banks behind the scenes. Traditional banks are watching as the infrastructure for crypto grows into something that starts to work with their main business: payments, settlements, custody, and managing cash flow. Cryptocurrency was easy to write off for years as a waste of time. That's not true anymore. When crypto companies get banking licenses, start using controlled frameworks, and connect to old systems, the threat becomes real. Because of this, There is a lot of disagreement about interest, income, and stablecoins. As a way to keep value, Bitcoin doesn't scare banks. They don't want to lose their cheap fees. They are scared of being cut out of the process. They are scared of a world where money moves more easily, quickly, and cheaply, and they don't have to take a cut at every step. And that fear is what's driving rules, not to stop crypto, but to change it. On the surface, the Clarity Act delays are annoying, but they also show us a lot. Lawmakers are no longer asking if crypto should exist. They are fighting over small things, rules, and who should get what piece of the pie. That means you're mature, not that you don't like them. When markets aren't regulated, they don't get controlled. Markets that are important do. The same trend is being seen around the world. It's not about ideas that the European Central Bank is working on the digital euro. It's about being useful. If money is able to be programmed, sent instantly, and used across countries, institutions that don't change could become useless. That's why countries that are wary of CBDCs are still getting ready for them. Choice is important. When people talk about CBDC, they don't always remember that states don't build everything themselves. They depend on technology, standards, and rails from the private industry. The way a digital currency is branded on the front end will not mean nearly as much as its interoperability, liquidity, and settlement layers. This is where networks that are already set up to handle payments become useful from a business point of view. At the same time, the XRP system is still being worked on in a very planned way. Instead of following every trend, the focus has been on adding more features without slowing things down. These terms, programmable escrows, smart extensions, and WASM modules, are not just trendy words. They are tools that businesses that move money use to solve specific problems. This is not advice about money. That's the main idea here. Put usefulness before hype. That's also why the time frame is important. When people hear 2026 or 2027, they don't pay attention. Institutions, on the other hand, don't think in months. They think in cycles. They plan years ahead of time. When everyone sees something for what it is, the easy wins are gone. When people are doubtful, bored, or unable to believe, they get the most out of their investments. Also, macro starts to become more important at this point. Capital will move outward on the risk curve again if liquidity grows the way many people think it will during the next cycle. It always does. First come big, well-known assets, then growth, and finally risky assets. Crypto is one of a kind because it combines technology, finance, and gambling. This means that when money comes in, it doesn't just trickle in, it floods. It's not that the market is broken, altcoins haven't had their run yet, it's just that the time hasn't been perfect. Earnings growth, fiscal stimulus, and loan expansion are the things that make people willing to take risks. And there are more and more signs that these ingredients are coming back in full force. Positioning will be more important than stories after that. The assets that already have infrastructure, rules, easy access to cash, and institutional knowledge will have a huge advantage. The way XRP is set up puts it right in that group. Price doesn't just go up. The market never goes in a straight line. Pullbacks, delays, failures, and shakeouts are all things that will happen. But the real direction is set a long time before the charts show it. That's why this time is so important, and most people find it uncomfortable. It's not hard to find information about investments. It means being patient and sure of yourself enough to act before proof. Most people wait until price proves what they already think. When belief is lowest and principles are highest is when professionals take a stand. That's the reason for this difference right now. Strong foundations, slow accumulation, and little price movement. At first it feels wrong, but now it doesn't. This isn't just true for XRP either. That's how every big, uneven chance starts. Before the iPhone, Apple didn't seem very clear. Amazon didn't seem clear before AWS. Bitcoin didn't seem like a good deal below $1,000. At the time, the chance always seems unclear. That's what it costs to get in.